Hello and welcome back to Money Control's live stream. You're watching Closing Bell with me, Lavisha Darad, and you can see that the markets are in red for the third consecutive day. It's been a broad-based sell-off today, and you can see that Sensex has plunged by about 1,000 points. Nifty has also broken way below that 24,000 mark. And yes, if you look at both the frontline indices, they have been down by 1% each itself. Market breadth has also weakened quite significantly with advanced decline ratio, which is standing at about 1:3. And you can see that India VIX has perked up in trade, which is showcasing that the volatility has definitely inched up in this market. But yes, given that it's been a broad-based sell-off, all the sectoral indices have been reeling under pressure. You can see that Nifty IT index has been leading the decline. It's a larger cut when it comes to the IT index with about 5% cut itself. So yes, not just today, but of course, if you look at, so far this week, we have seen that Nifty IT index has been under significant pressure, given that the street has been underwhelmed by the majority of the heavyweight Q4 performance itself. But yes, additionally, we do have FMCG, pharma. All of these pockets have been reeling under pressure. Nifty FMCG down by about 0.8%. Nifty realty also seeing a larger decline of about 1.5% each. And pharma index also, despite yesterday, we did see a bit of a defensive buying. But today, once again, a little bit of a profit booking. And of course, all of these sectors succumbing to selling pressure. Nifty pharma index also down by about 1.5% as well. But yes, much of the cushion that was earlier in the week that was being provided by the broader end of the markets, both the mid-cap and small-cap indices, they have also fizzled out. And you can see that both Nifty mid-cap, that is down by about 1%, small-cap index also down by 1% each itself. So yes, you can definitely see that the market volatility has inched up, which showcases that the markets are fearful that there is no resolution which is reached between Iran and US in the West Asia. And of course, the blockade also continues. And because the blockade has been continuing, the supply fears has also been under the radar. And that's why you can see that the Brent crude prices have been continuing to hover above that $105 per barrel. So yes, because of such oil price swings, we've also seen that Rupee has depreciated to over a decade low. Right now, the Rupee is at about 94.28 against the US dollar. We'll just flash it on your screen. But yes, Rupee has also been depreciating for the third day in a row itself. So overall, it's been a weak setup for the markets today. And of course, for overall this week also, given the kind of mix-up we have seen throughout this week, both the Sensex and Nifty, they have been down by 1% each. And with this decline over this week, they've snapped their 2 weekly gains that was provided in the previous week itself. But yes, apart from a sectoral point of view, I was mentioning that IT stocks, they have fallen this week, given that Street has been underwhelmed by the sector's Q4 results. Earlier in the week, we also saw that HCL Tech, which was, which brunt the worst of the sell-off from the IT sector, given that it pointed out certain AI-related deflation worries. And that's why you can see that majority of these IT counters have been under radar. Infosys also, which gave out its numbers for the Q4, missed the street estimates. And of course, their revenue growth guidance for FY27 was also much below than what the street was anticipating. And that's the reason why the IT stocks have been, under the radar as at this point of time. But yes, let's take a look at how the top gainers and losers look like from the Nifty 50 front. You can see that Coal India has been doing well. It's one of the top Nifty gainer. Shriram Finance with about 1% gain coming in, ahead of its Q4 numbers today. Trent also with about nearly 1% gains coming in from there as well. Nestle also doing well with about nearly 1% gains. Of course, the stock has been, picked up by the investors' buying interest, given that it had posted some good Q4 performance, and since then the stock has been doing quite well. Apart from that, you can see SBI also with about nearly 0.5% gains, Hindalco with about 0.5% gains, Bajaj Finance with about 0.2% gains, and then you can see Bajaj Auto and Kotak Mahindra Bank also with about flat but with a positive bias. But yes, let's take a look at what is not doing well in this market from the Nifty 50 front. You can see majority of these IT counters remaining one of the top Nifty laggards. Infosys with about a 7% cut. HCL Tech also not doing well today with about 5.5% cut. TCS with about 5% downtick. Tech Mahindra with about 4.5% cut. Then you can see Sun Pharma not doing well with about 3.5% decline. SBI Life with about 3% decline. HDFC Life, both of these, insurance counters have not been doing well. Wipro with about 1.5% cut, and HUL also seeing a decline of about 1% itself. So yes, weak setup for the markets, and let's quickly understand what all of this means for our markets, and of course how the last minutes looks like. I will quickly go across to my first guest of the show. We have Nirav Chedda, who's the Assistant Vice President, Equity Derivatives and Technical Research Retail at Nirmal Bank, joining us. Nirav, good afternoon. So good to have you. And of course, it's a weak setup for the markets. Nifty has broken way below that 25,000 mark, and we're seeing a broad-based sell-off. With what has happened this week with the West Asia tensions, oil being back above $100 per barrel, what levels are you tracking for next week?
Yeah, hi Lavisha, thanks for having me on the show again. Nifty per se, there has been more than a 2000 point rally from the lower levels, and this rally has come fast. So always, the 50-day moving average acts as a resistance when the Nifty is trading below it. Nifty did, go towards the 200-day moving average, which is 24,400 odd levels, and from there couldn't hold on and came down. So we are closing below the 50-day moving average, and there's a good chance that probably in the next week or so, Nifty will again look to break out above the 50-day moving average. Once that happens, you will see good buying action again returning in Nifty. From a medium term per se, I definitely believe we have bottomed out, and there can be some consolidation here before the 50-day moving average breaks above. Nifty breaks above the 50-day moving average, and then probably reach for levels of 25,000 and probably higher. So as of now, the positioning wise, I would suggest that in the next week or so, if you get 23,800, 23,700 on the Nifty, look to buy with a stop loss of 23,500. Your target would be 24,400, which is the 50-day moving average. And then, we'll take it post that. But as of now, that should be the target. Very similar case for Bank Nifty as well, where both the 50 and 200-day moving averages are placed, very near to each other. I believe until the 57,080 levels on the futures is crossed above, you will see some consolidation coming in. But this has been the stronger of the two indices, so there can be a little more downside than what Nifty will see. This can probably come down to a 55,300, 55,000 levels, which is where I would suggest to buy Bank Nifty, and you can probably buy this with a stop loss of 54,500 levels, and again witness some buying post that up to 57,000 levels. So as of now, for both the indices, I'll be waiting for some little bit of downside and buy on support levels.
Buy on support levels for both the Nifty and Bank Nifty index. Since you were talking about Bank Nifty index, Nirav, what about HDFC Bank and ICICI Bank? Today, if you look at both of these counters, HDFC Bank has been faring better than ICICI, and ICICI is down for the third consecutive day. So, going ahead, how do you see both of these counters doing? And of course, we did see both of them reporting their March quarter performance earlier in the week itself.
Yeah. So, see, Lavisha, what has really happened is if you take out the last 5 years, HDFC Bank has been a clear leader, and this stock was in a longer term uptrend. But in the last 5 years, ICICI Bank has taken over the leadership, and you've seen a linear rally in this stock. Now, finally, you're seeing some downside in ICICI Bank. A top kind of a formation has happened. So definitely, I would suggest that if you bought ICICI Bank, this would be a good level to book profits and then switch to HDFC Bank again. Why? Because there has been a huge rally which has come in, and when Nifty was going down, this stock still made newer highs, and it has remained near the higher levels. So there's a good chance now some sort of consolidation will come in ICICI Bank. There's a good chance it can come down to 1100, 1200 odd levels. Consolidate there for a bit and then move up. But for HDFC Bank, the consolidation seems to be over. I believe it's a good level, 780, 800 odd, to add this stock, because there's a good chance of a bounce coming in here up to the 1200 levels from here on. and it will again regain the leadership probably going forward, looking at the chart and the volumes that have happened at the lower levels. So look to buy HDFC Bank here. You can keep a stop loss of 740, and your first target should be around 920, and then probably 1000. Then obviously it will go up towards 1200 odd. But as of now, HDFC Bank is a buy and ICICI is a sell.
Okay, all right. HDFC is a buy and ICICI is a sell. All right, that's the key takeaway. But let's move on and talk about some of the individual movers from the banking index as well. Yesterday, we saw a steep sell-off in Union Bank, given that the street was disappointed with its Q4 performance. Today, also the stock remains under pressure, and in the past 2 days, we have seen that the stock has declined by about 8%. Nirav, what's your call on this particular counter? Are you going to remain sideways?
Uh, Yeah, I mean, this stock in a last 1 month or so has been in consolidation, with the upside being 195 odd and downside around the 165, 170 odd. If it comes to 170, that is when I'd look to buy again. But as of now, nothing interesting in this particular stock where, this is a screaming buy. I would like to avoid it at this point of time.
Okay, and avoid for Union Bank. All right, let's move on and talk about IDBI Bank, because this particular counter saw a sharp intraday spike after Finance Minister at an event said the divestment process is likely to continue, and which is why IDBI Bank has done quite well today. Nirav, earlier we did see that the stock spiked to above that 100 odd levels when the divestment news was doing around the corner. Do you think that the stock would reach that level, or is that just too optimistic as a target level?
I think at this point, the stock has come off after, 5 years of upward rally. This stock went up from 20 odd levels up to, 110, 114 odd levels, and then witnessed a sell-off. So I think the rally for the last 5 years is over. There's a breakdown which has come in this stock. Yes, there has been an upside in the past 2-3 weeks, but I believe 82, 83 odd levels will act as a strong resistance on the upside, and then you can probably see this stock falling further from there on. So I would not be a buyer at this point of time. In fact, you have bought lower. This would be a good level to book some profits, at current levels, and as it moves up towards the 82, 83 levels.
Okay, all right. That's the view for IDBI Bank as well. Of course, the stock is seeing right now about 3% uptick for this time being, 3.5% gains. Of course, we did see a spike to about 79 odd levels, but then it's cooled off from the day's high. But yes, let's move on to the top sector of the day. Of course, it's the IT sector which is seeing the biggest casualty for this week, a larger meltdown and about a 10% cut for this week itself. Nirav, earlier we saw HCL Tech seeing a sharp fall. Today we have Infosys reacting to its numbers. What's your take on overall large cap IT names?
Uh, so basically, when this month started, there were a lot of short positions in IT and even in Nifty per se. So definitely, the thinking was that there can be some short covering action which can probably come in, and which came as well. But this was very short lived. Most of the IT names went up, but suddenly came down and have broken down since. So, something like an HCL Tech, Infosys, Wipro, TCS, Tech Mahindra, they've all witnessed negative formations, and they're closing the week on the lowest level. So definitely, as look like these stocks will probably come down even further in the next week or so. There are breakdowns and continuation patterns which are happening in most of the stock, which is a negative. So I would not be a buyer at this point of time. In fact, if you have IT in your portfolio, it would be good if you can hedge it or exit it for the time being.
Okay, all right. Hedge it or, for the time being, that's your IT stocks. What about the mid-cap IT names, Nirav? What's your take there? Because earlier yesterday, we did see Persistent Systems also coming under pressure after its Q4 numbers. Other stocks like Cyient also reported its Q4 numbers. That is also under pressure. Do you think, is your take same for this, for the mid-cap IT names as well?
Yeah, very much so. So, for persistent, I see a much larger downside. So, this was one stock which was in a linear uptrend. It saw high top, higher bottom formation since a long time, and now a double top kind of a formation has taken shape in this stock. So, there's a good chance that more selling can come in here. Also, a very important support level for this stock is around 45.80. If this is broken below, you will see a good amount of downside, which can probably take the stock lower towards the 4,000 level. So, at this point of time, my view is the same for Midcap IT as well. Even for Cient, the same thing. Yes, probably Oracle Finance is the only stock which is looking out like a breakout, but others are still in a downward trend, and I would avoid Midcap IT as well.
Hmm. Okay, you would avoid mid-cap IT names as well. All right, let's move on and talk about another sectoral pocket which has been a top sectoral laggard. That's your Nifty Auto Index. So far this week, this index has seen a decline of about 2%. And right now also, the index has been reeling under pressure with about 0.5% cut. Nirav, what are you making of the moves? Of course, the sector has been down for the second consecutive week now.
So, see, auto as a whole, most of the stocks were in a long-term uptrend, and post March, I mean March, almost all stocks witnessed selling pressure. But auto per se, they've made long-term top formations, and whenever such things happen, it takes about 3 to 6 months of consolidation, maybe higher, for these stocks to actually witness good broad-based buying. So they've just started their downward leg, and I believe it is one sector which one can avoid, at least from the 3 to 6 month perspective, even from a near-term perspective, because there will be incremental selling which can probably come here. Stocks like Ashok or TNCV or the others. I believe some more selling is likely here, and they will be under the pump, or under the selling pressure for the next few days.
Okay, you expect selling pressure to continue for the next few days. All right, let's move on and talk about some of the individual movers of the day. And we have Himadri Speciality. This particular stock has hit a fresh 52-week high on the back of its solid Q4 numbers. And in terms of metrics, we've seen that full year EBITDA has touched a historic milestone of about 1,000 crore rupees. PAT also surged by about 36% on a year-on-year basis. What's your call? The stock has cooled off from the day's high levels, but still 5% gains.
Yeah, almost all chemical sector stocks have seen good run up in this week. In fact, in the last couple of weeks, and most of them have broken out as well. So, HSCL per se, good breakout here as well, above the 500 levels. I expect this stock to come toward the 670, 700 levels. One can look to buy at current levels, and on certain declines up to the 530 odd levels, 500 will be the stop loss.
Okay, all right. That's the view for Himadri Speciality. But yes, right on your screen, you have UTI AMC, which is also not done well with about 10% decline coming in. Of course, the company did report a net loss of 51 crore rupees in Q4 versus a net profit of 102 crore rupees clocked in the same quarter in a year ago period. And the profit was impacted due to MTM, which is your mark-to-market losses itself. And that's why you can see that the stock is seeing a steep decline today with about 10% at this point of time. Nirav, what's your take for UTI AMC? How does the stock look like from a near-term perspective?
Doesn't look very good. There's a double top kind of a formation, and then decline from that. Very important support level is 920. If this is broken below, you will see further selling in this stock, and stock can probably go down towards 800 level. So if you're holding on to longs, 920 will be your stop loss.
Okay, all right. That's the view for UTI AMC. Let's move on and talk about Tips Music, because this stock is doing well for the second consecutive day with about 2% gains. And we have seen that revenue has grown by about 32% on a year-on-year basis, while profit has grown by about 93% on a year-on-year basis, which is why the stock has been reacting well to its results itself. But yes, so we've seen a strong comeback from the March lows with about 30% gains. Nirav, what's your take? Do you think this uptrend can sustain going ahead?
I think so. So there's a 2 year of down cycle which has happened in this stock, and then finally a breakout now with volumes. So good chance this stock can go up towards 780, 800 levels. So one can look to add positions here, and on certain declines, you can give a stop loss of 600 for your longs, and 800 would be your target.
All right, 800 will be the target for tips music. All right, let's move on and talk about SBI Life shares. It's one of the top Nifty losers, and the stock has fallen from its intraday highs after comments which was made by Union Finance Minister Nirmala Sitharaman, which raised the possibility of changes in the insurance distribution norms. FM said that a government appointed banking committee will be examining whether an open architecture model should be adopted for distributing the insurance and other financial products. So yes, which is why we've seen not just SBI Life, of course, HDFC Life has also taken a hit. It's one of the top Nifty losers. What's your take, Nirav? I mean, the stock is reacting negatively to the news flow.
Yeah, and a lot of volumes have happened as well in the last 2, 3 days. So looks like top formation is in the offing for this stock. I would suggest to exit the counter if you're holding on to, because there's a good chance this stock can come down to a 1600 levels.
Okay, all right. That's the view for SBI Life. Of course, the company has also reported its Q4 numbers, which is why the stock was also not reacting well earlier. But yes, the last rates coming on your screen where Nifty has closed well below that 24,000 mark. And so far this week, we have seen that the index has slipped by about 2% itself. So yes, 200 points decline coming in for the Nifty 50 index. Sensex has also declined by about 900 points with about a percent decline coming in for there as well. So yes, markets have been edging lower for the third consecutive day for the time being. And you can see that it's been a broad-based sell-off, which is why Bank Nifty is also down by about 200 points. And you can see Nifty Midcap also closing in the red with about 500 points decline. But yes, let's take a look at the other sectoral pockets of what is doing well and what is not. All the sectoral indices have ended in the red. Nifty IT index, like we were talking about earlier, that has concluded the session with about 5% decline. And apart from that, you can see Nifty FMCG with about 0.7% decline, Nifty Metal Index with about 0.3% decline, Nifty Realty is not doing well with about a percent decline coming in for there as well. And you can see that Nifty Pharma Index, which was one of the top sectoral gainers, that has also slipped with about a percent decline. So yes, it's been a negative day for the markets, and given that there is no resolution which is coming in from the West Asia conflict, you can see that the India VIX has perked up, and it's pricing in some risks which is coming in from the Brent crude prices as well. But yes, the markets have been showcasing a negative trend. You can see that the advanced decline ratio currently stands to about 1:3, definitely showcasing that the market breadth for the time being has weakened at this point of time. But yes, let's take a quick check of how the gainers and losers look like on the Nifty 50 front. You can see that about only 12 stocks have advanced, while 38 stocks have declined at the current moment. And amongst the gainers, you can see Coal India, Trent, Nestle India, which have been showcasing gains of about up to a percent itself. Hindalco with about 0.5% gains, SBI doing well with about 0.5% gains, Bajaj Finance ahead of its Q4 numbers, which is due next week. It's doing well ahead of that. Shriram Finance with about flat with a positive bias. Bajaj Auto and Eicher Motors remain some of the other gainers on the Nifty 50. But yes, amongst the losers, you can see that all of these IT stocks have been under pressure. Infosys with about 7% decline. HCL Tech ending the session with about 5% decline. TCS also ending the session with about 5% decline. Sun Pharma with about 3% decline. SBI Life, both the life insurance players, they have been showcasing a decline of about 1 to 3%. HDFC Life and SBI Life. HUL also showcasing a decline for about 1.5%. And you can see ICICI Bank, Wipro, all of them remaining some of the other top Nifty losers at the current moment. But yes, let's take a quick take of Bajaj Finance, which is doing well ahead of its Q4 numbers, which is due next week. Nirav, what's your take for Bajaj Finance? The stock is up, marginally up ahead of its Q4 numbers. How does the chart look like for the near term?
It's very sideways. Nothing really, exciting in this stock at this point of time. Yes, if it breaks out above the 950 levels, you will see a good rally in this stock up to 1020. But as of now, it is stuck in a range of about 950 on the upside and 900 on the downside. It needs a breakout or a breakdown. So as of now, I'll be, avoiding. Once that breakout comes in, I'll buy for that target of 1020.
Okay, all right. That's the cue for Bajaj Finance. Let's take a quick check of how Cochin Shipyards it has also been doing, because right now the stock has concluded the session with about 5% gains. It's bucked the weak market trend and did see some good moves today. Nirav, what's your take? The stock is above that 1600 odd levels. Do you think the run up will continue going ahead?
I think so. I believe this stock is now primed to move up toward the 2400, 2500 levels. Why? Because, after a period of more than 3 years or 2 years, this stock has finally broken out. And there's a good chance this will be a very fast rally. There's very good base building which has happened around the 1200, 1300 levels and then a breakout. So look to buy the stock at current levels as well. And if you get certain dips, do buy it there as well. 1500 will be your stop loss. And first target should be 2000. That is where you book certain partial. And then 24 to 2500. And that should be very quick.
Okay, okay, got it, got it. Let's also get your view on Reliance Industries, which will be reporting its Q4 numbers in just some time. The stock has concluded today's trading session down with about 1% loss. What's your take here, Nirav? What are you anticipating in the near term?
See, the trend is negative. Lower top, lower bottom formation is taking shape, and it is not able to cross above the 50-day moving average, which is around the 1380, 1390 levels. Once the breakout comes in, that is when you will see the stock moving up. But until then, there's a good chance this stock comes down towards 1250 or.
Okay, okay, got it. All right, that's the view for Reliance Industries. All right, just one last question before I let you go, Nirav. What are your top picks at this hour? Anything that you're finding attractive at the current price point?
Yeah, so first is NMDC, very good close for this stock, above the 88 odd levels. I believe this stock can go up towards 100 levels, so you can look to buy the stock at current level with a stop loss of 84. Second is Dixon Tech. Very good base building has happened in the last week. There was a breakout and then a retest happened this week of the same breakout. It is close near the retest levels. I believe good buying action should come in this stock in the next week, and it can go up towards the 12,000 levels. So one can look to buy this stock with a stop loss of 10,400.
Okay, all right. NMDC and Dixon Tech remain some of your topics. All right, appreciate your time with that. We have to let you go, Nirav. Thank you so much for joining us.
Thank you.
All right, markets definitely closing lower today for the third consecutive day. And of course, for this week, we have seen a tumultuous ride for both the frontline indices as well. Now, before we move on to our next set of conversation, Rupee today has also sunk to about 94.2 against the US dollar, and it's closing lower from yesterday's session as well. Now this is coming in because of the oil price swings, given that Brent continues to remain above that $105 per barrel. But yes, listen into this conversation which earlier happened with Pranav Mayer of JM Financial, and what he had to say about what the near-term outlook for Rupee lies in, as well as for the Brent crude prices.
There could be a possibility of a period of consolidation. We may see Rupee trading between 93, 94.50 in the coming trading sessions, but the bias is expected to remain on the negative side. It is likely to remain under selling pressure. 95, 95.20 would be the hurdle the Rupee may be facing on the higher side. Any breakout above this level, we expect Rupee to depreciate further close to 96.50, 98 levels towards the year end, that is the calendar year ending 2026. So that is how the Rupee is expected to trade. Any appreciation towards 92.50, 98 towards 92.80 would again attract hedgers coming in at lower levels, to hedge their positions. In fact, there could be stronger demand from the importers as well around those levels. And speaking about the dollar index, if we see the dollar index for the past 1 year, it has gone nowhere. It is stuck between 95 to 100 levels. So it's a range within which dollar index is consolidating over the past 1 year. this week the price rally is now getting more supported by lack of supply coming in from the Middle East, especially from the state of Hormuz, which remains completely shut. Prior to the ceasefire that was announced last weekend, in midweek, where there was a possibility, there were at least few ships moving with the permission of the IRGC. However, now it's completely choked. Even Iran has stopped, has choked from its side. The US has choked from the outside. So there are no ships that are moving out from this. And the impact that we see, the oil prices are likely to remain elevated. Brent crude definitely will remain supported on the higher side. WTI crude will run up in expectation of more ships moving to the US to get the supply. So the demand for the WTI crude will increase in the market, and that should keep the oil prices elevated. Unless and until there is any resolution to this, we don't expect oil prices to fall very quickly or very go down beyond 80 $85 on the downside. Yes, any news or any sentimental comments coming on the positive side for crude may push the prices again down close to 90, but we don't expect a bigger correction until unless the things get completely settled down in the Middle East.
All right, that was Pranav for you, saying that Rupee might consolidate at the current levels and Brent crude prices are likely to remain above the $100 per barrel unless and until we see a resolution to that US blockade for the time being. But yes, let's move on and to our next guest of the show to talk more about markets and of course to decode the Q4 earnings as well. We have Karan Agarwal, who's the co-founder and CIO of Ametra PMS, joining us. Karan, good afternoon. So good to have you back. And
good afternoon.
Good afternoon. Karan, once again, the market's in red amidst all of these war-driven headlines. Your first thoughts on how the markets have fared this week, and of course, what are you watching out next?
Looking at the market, it seems like there's a clear disconnect between oil market and stock market. Okay, and it's not just India; it's global phenomena. Basically oil has increased to around 106. We are expecting levels of around 90 by end of this week, but it's above by 15%. But if you look at the equity markets are still factoring in that oil would be back to 90 by end of the month. And things will start normalize. Eventually, the oil will move to 70 in next 2-3 months. So if oil is above 100 by month end, and we see a specter that oil is moving beyond, let's say, remain at level of 100 beyond April into May, June, there's a very extremely high probability that the lows that we saw in March might be breached.
Okay, got it. Karan, but then do you think, given, there is a lot of factors when it comes to the resolution of the US-Iran conflict, but do you think that until that happens, the sideways trend in the markets is expected to continue? Because despite the recovery that we saw last week, we've erased all of those gains and frontline indices have been down by about 2%.
See, the reality is that if you look at the budget for FY27, it assumed that oil would remain at $76. Okay, but we are looking at a prospect that oil might remain about 90, or let's say it remain range bound between, in a good scenario, it remain range bound between 90 and 100 throughout the year. Every $10 increase in oil eat up around 40 basis point of GDP growth. And if we model, the impact of oil spike on earnings, if we model it on Russia-Ukraine crisis in 2022, we can see 200 to 300 basis point spread across corporates on account of rising yields, rising input cost. Okay. Already, if you look at the bank results from HDFC and ICICI, there is a hit on treasury income, which is clearly visible. So the problem is that right now the estimates are factoring in oil at 76, but we are looking at oil at 106, and even if things, they become a bit comfortable. Let's say things start, even if there is a good news in the air, that there is some sort of thaw in the hostilities between US and Iran. So oil is protecting a bottom of 90 as of now. So these are the realities which are staring us in the face, and that's why the problem is that if there is there's a margin compression, valuations, there would be a de-rating in valuations, and markets might there's a possibility that markets might breach the lows in March 2026. The real problem is the margin compression that will come with the oil at above 90, rising yields, a weakening currency. So these all would weigh on the earnings eventually.
Okay, got it, got it. So, in terms of earnings growth, what are you expecting now from FY27 versus before the war started? Because you were saying that earlier we were assuming oil to stay above that now, $70 per barrel. But since then, we have seen quite a bit of a spike, 40 to 50% from those levels. So, in terms of growth estimates, are you like revising your estimates for FY27?
So for FY27, we believe that it would be difficult for GDP growth to be above 6%. Okay. We can see a rise in inflation. There would be weakening currency. The major problem that we see, the major trouble we see in rising yields. Okay. 10-year yields are already near 7%. And that will increase the borrowing cost for the government. So overall, the capex expenditure, they can be hit on capex expenditure as well. So these all factors which are there. We were expecting that earlier before oil spike that there would be 1 or 2 quarters of EPS stagnation. Okay, and there would be a reversal. There would be a EPS stagnation bottom out by Q2, and there would be a strong reversal in Q3 and Q4. That's a cyclical trends. We see the last EPS stagnation cycle of 11 to 13 and 17 to 19. These are the trends typically to take 8 quarters in general. But here the oil price spike has complicated the things. We believe that right now earlier we were expecting EPS growth rate to be around 12% for the year. I think we have to scale it down to somewhere around 5 to 6%.
Okay, 5 to 6%. This is for the Nifty earnings growth. Or are you saying for the broad-based
Nifty
universe?
500. Nifty 500.
Okay, got it then. Yeah. All right. We've seen that, at this point of time, like you're saying that, we could expect 5 to 6% EPS growth. So do you think that, it's going to be even more difficult to find value in a market like this?
See, the problem is that if there is a earning compression, margin compression, we are going to see EPS re-rating, EPS de-rating, sorry. So the banks are already struggling with weak treasury income, okay, on account of rising yields. IT companies are going through a restructuring on their as an impact of changes in AI. We are looking at a stagnant revenue growth. We might see negative revenue growth for a few quarters. Okay, so the value, if you talk about in terms of value, the value mostly we see the power sector as one of the area which is rich in value. There's a data center theme. There is no right now power sector is seen as a kind of a seasonal play. Okay, there is a spike in summer demand and typically grow at 8 to 10% EPS. So as of now, market has not factored in the data center theme at all in power sector. So this is one of the sector where you can find some value. But overall, if you talk about broader market, valuations are quite in unsustainable zone. If you look at the Midcap index, it is trading at 30 to 38x of on trailing basis P. If you look at small cap, it's around 30x. Nifty is around at 22x. Normally, the growth rates, if you consider even the growth rates for last 4 quarters, forget about the oil spike and any impact. At 8 to 10% EPS growth, these valuations are not justifiable. You are talking about PEG ratio of 2 to 3x. And that's why FIIs, that also explain kind of some FII outflows to some extent. If you see the other markets like South Korea, Japan, even Taiwan, their PEG ratio is around 1.5. So the markets are quite frothier and it's not reflecting the EPS de-rating cycle that has taken place over the last 4 quarters. It's generally, these kind of valuations are justified at 15 to 20% EPS growth. Some analysis are pointing out to 2022 like situation, but in 2022 we were coming out from COVID lockdown. So there was a natural upswing, which was there. Private PSU banks balance sheets were cleared after a very long time. There was a credit uptake cycle. We are looking at credit growth of nearly 15%. Real estate was booming. There was spike in IT salaries across the board. So there are a lot of factors which cushioned IT oil spike that time. Okay. So those kind of, if you look at those factors, those drivers which cushioned oil spike during 2002, kind of all of those factors are weak at this point.
Okay, got it. Karan, then amidst all of this energy supply disruption that you've been pointing out, do you think that renewables is the best place to be at this point of time, given that government's focus has also been, towards the push of local renewable manufacturing and, of course, sourcing the energy on a local basis? So, what do you think? I mean, is this going to be the next dark horse story for the next decade?
The renewables as a story took off pretty well in 2022 during last oil spike. And we can see a return of focus on renewables as governments might be able to provide some sort of subsidies or some incentives to promote use of renewables and moving away from fossil fuel, which is in a country like India, it's actually a big headwind. These dependence on fossil fuel. But the problem is that right now the rising yields might make it difficult for government to offer those kind of SOPs and incentives. But overall, there would be a gradual shift. There might be a offtake on for EV in EV space, and I think the next 5-10 years next 5 to 10 years we can see a substantial amount, nearly 50 to 60% power generation moving to renewables. So renewable in general is a great theme, but I think if people are looking for a quick rebound or a quick money as of now, so right now government's finances would not support. But yes, in the long term, to avoid the present situation, we are in the midst of second spike within just 3 years. So on the long term, the policy makers would like to move in a situation in next 10 years where 60 to 70% demand for fossil fuels is replaced by renewables, which are available in abundance.
Okay, got it. Karan, then what is the investing strategy you would recommend for investors? Because, obviously you're talking about, how the valuations are still up and, of course, the growth trajectory is somehow missing out because of the energy supply disruptions and, of course, the Brent remaining above $100 per barrel. So at this point of time, what's your recommendation? And, of course, how should they view the markets in terms of their strategy?
See, as of now, if you are looking at investment for, let's say, 12 to 24 months, and looking for short-term market view, we see a lot of headwinds. It's quite possible that none of these headwinds materialize. That's also quite possible. Rising yields will bring other macro geoeconomic factors into play, like interest rates by Japan, sovereign troubles in US debt segment. So a lot of headwinds are there as of now. If we're looking for next 2-3 years, our recommendation is to reduce the risk to large extent, be on the low beta side. But we are looking at a kind of a deluge of populist schemes in India. Okay, these populist schemes are in general damaging, but they can support FMCG sector. We have seen a revival of double-digit growth rate after stagnation of 4 quarters in FMCG. There were green shoots in last quarter. Nestle is the one which has declared the result, basically some few days back. And it is sustaining double-digit growth. We can see that trend across the FMCG sector because of these populist schemes. Second is on power sector, the demand is quite secular, and we can see a spike due to data center data center theme, which is not priced in yet. Okay. On the other side, because we expecting markets to give some dips on the way, there would be some areas, some contrarian plays. IT we see as a more of a contrarian play as of now. We are not looking for quick returns here, but IT is going through restructuring. There would be pressure on the top line, but the bottom line, because companies are going through restructuring, there would be some cuts in the workforce and all. We believe that after 2 to 3 years, these companies will emerge with better margins and a much stronger bottom line. Okay, so the investors who have patience for next 2-3 years, who can go through some tough times, they can use troubles in IT companies actually to gradually deploy capital and accumulate the shares at lower price so that they can look for windfalls after, let's say, 3 to 5 years. Uh, so these are the some of the areas where where investors can actually, in times of correction, they can accumulate the quality stocks. But you need a patience of 3 to 5 years there. On the on the consumer discretionary side, we see some stress going forward on account of stagnation in IT. There would be some second degree impacts. There would be because discretionary portion of urban income might go down significantly. So, but we look. Our recommendation would be to basically to avoid hotels, airlines, uh, even the real estate, to some extent high-end auto stocks. Uh, Even the consumer finance company, which are coming with a very big chunk of unsecured loans. So we believe that for next 2 to 3 years, as we are going through a transition in the IT sector, which is main employment generator for white collar. So there would be a shift from consumer discretionary to consumer staples for quite some time. And so after 3 years, we might be looking at consumer discretionary sector as the next growth driver.
Okay, okay, got it. So, from what I have gathered, you are more bullish over utilities and consumer staples for the time being.
Yes.
So,
Yes.
Karan, among this, of course, these are all the defensives that you are mentioning right now. What about the pharma sector? How are you placed there? I mean, of course, we have a weaker rupee, which could provide a tailwind to the sector, but how are you placed here?
See, we are taking we have good positions in actually we have substantial positions in pharma sector as of now. We believe that pharma sector is it is a defensive sector, and through the global upheaval that we are going to see in next 2 to 3 years, sector is it's more of a defensive bet. On growth side, on price appreciation side, the problem with the pharma sector is extremely high valuations. Pharma sector has delivered substantial returns in last 5 years. But the valuations that right now the valuations are not supporting, are not making a case of uh, substantial price appreciation. They are the major headwinds. They are not supporting the growth numbers that are there for pharma sector right now, not justifying. But the investors who want to park the capital in the market for now, okay, and looking at some sort of defensive bet, they can definitely look at the pharma sector.
Okay, got it, got it. Karan, what about the metals? Because metals have also been doing well, and of course, there's a supply crunch when it comes to aluminium. How are you placed here? Be it the names of Hindalco, Vedanta, all of these counters?
See, the metals have done extremely well in last 1 year. Okay, it's one of the best performing sectors. I think after bank, it's at par with bank. If you look at the returns for last 1 year, but the major problem we see with the metal sector today is we see a prospect of US dollar index getting stronger over next few months. Okay. We are looking at that maybe in next 1 year, we might see a number of 110. Then it should be negative for metals. In the metal play, we see more as in terms of gold silver ratio. So gold silver ratio right now is around 60 to 70. We believe that once the gold silver ratio reach somewhere around 80, 85, there will be some valuation comfort to go for more metal stocks.
Okay, got it, got it. All right, any pockets that's a clear avoid for you? Is it? I mean, of course, you mentioned about IT stocks, which you are staying a little cautious on. But apart from that,
so basically, we are avoiding areas marked with consumption. We are avoiding consumer discretionary theme for now. Till the time we get a clarity on impact of IT on the workforce dynamics, basically impact of AI on workforce dynamics and IT, we believe that entire urban consumption story or consumption discretionary story is completely driven by IT incomes. That has been a consensus for last 20 years that these incomes will continue to grow, middle class will continue to grow. There is some apprehension about that assumption today that it might sustain for next 3 years or now, or 3 years or not. So we would like to wait out on consumption discretionary scheme. As I mentioned, we would avoid airlines, we would avoid hotels, even the consumer finance companies, real estate, high-end auto like some companies Ica Motor that sell high-end motorcycles. So these discretionary, we see the discretionary portion of urban middle class income is going to shrink for next 2 3 years if AI fears on IT materialize. And the problem is that the valuations are still not reflecting those sort of risk. Those secondary and tertiary impacts are not being reflected in the valuation. On IT side, their troubles are still to some extent are being reflected. But in these sectors, in consumer discretionary, the valuations are still too elevated, and they are not reflecting the risk associated with secondary and tertiary impacts of AI impact on IT workforce.
Okay, got it, got it. All right, with that we have, we have to let you go, Karan, but thank you for a lovely conversation and appreciate your time.
Thanks.
All right, that was Karan taking us through what the Q4 earnings holds and of course some of the sectoral pockets that are finding value at the current moment. But now in just some time, we'll also be having Reliance Industries, which will be reporting its Q4 performance. And while retail and telecom is expected to support growth, oil and gas segment is expected to remain weak. Here's what my colleague Anubhav had to say about the expectations from Reliance Industries' March quarter performance.
Let's talk about the segment which are easier to talk about right now. Is there, the cash flow business from retail and telecom, which both we think that sequentially they should do well in Q4 as well. Telecom largely because of the uptick in data consumption per capita, so ARPU should actually improve. Retail also, if we look at the insights coming from the peer side, whether it's the results from Trent or the business updates from the likes of V2 Retail, VMart, Bazaar Retail, it points to probably as far the Q4 is concerned, retail business should also be at least stable. Of course, big question remains what lies ahead for the current fiscal in the new macro environment setup. But then that takes account of something around 55 to 60% of Reliance operating profit, retail and telecom, where the operating environment is really dramatic. Is the legacy energy business of Reliance, and particularly for the OTC segment. So a month back or 1.5 months back, the sourcing of crude oil was something around 70. Now the effective price is told to be much at premium to what even Brent is showing. So something around 120 is being talked about. So that makes the operating environment really complex, and add to that, the insurance cost and freight cost, which are also elevated. But what comes handy for Reliance is their really complex and nimble refinery and cracker complex, which helps them to gain better margins. So diesel cracks are supposed to be really doing well as for the last month is concerned. Even for the current month, it is being talked about. And same goes for the product cracks as well. I think there's a bit of a mix because some of the products like PVC prices have come down because of supplies from China, but the other sort of polymer prices like PP, polypropylene, polyethylene probably are still doing well as far as the deltas are concerned. And what more can benefit Reliance, or at least help it offset the operating and sourcing cost, is the fact that a number of refineries of Asia are actually operating at suboptimal level. And that helps Reliance to operate at a higher utilization level. So that's something which would help Reliance to offset.
All right, thank you, Anubhav, for taking us through what we can expect from Reliance March quarter numbers. But yes, that's all we have for this edition of Closing Bell. We'll get you more earnings reaction next week, and of course with what happens in the West Asia. For now, it's a wrap from me, and do have a very good weekend.